So just for starters, I do think that we should all realize why this is happening, right? So I just had this weekend, I spent with CEOs of leading European banks, and the world is trying to digest three major shocks to the economy. The pandemic still coming out or really going back in, lockdowns in China, the war, which is another supply shock, and a massive energy transition that we're also trying to get through, right? So these are major shocks to the general economy. So that it is pretty difficult to establish a path at this moment in time as to where growth should be, where rates should be, where inflation is going to be. That's quite predictable from that perspective. That's why you see the volatility in the market. And that's for us, in terms of how we deal with our clients, the moment of truth in terms of assuring our clients as to what to do or not to do, and being closer to them in our advice. And at this moment in time, given the fact that many things are happening at the same time, you see that clients are not necessarily kind of disengaging from the market, so they're still engaged, but they're not adding to it, right? So more or less in a kind of on the sidelines as to waiting for things to clear up, whether it's going to be direction that we can follow through. And that's the advice we're currently working through with them, depending on their portfolios, etc.
Are there any parts of the markets at the moment where you think we're beginning to see disorderly price adjustments? I think we all understand that volatility, if you get predictable moves, it can be managed, and there are opportunities. Once it becomes disorderly, the kind of thing we may have seen with some of the cryptocurrencies as an asset class, then it becomes much more dangerous for everybody. As you think about, for example, the technology companies, is this the tech meltdown 2.0 in your opinion?
It's not, in my view, right? It's clearly there's a question as to what should the exact market value be of some of these models, but the underlying business models are true business models, not only now but also for the future, in terms of delivering services, advice, and what have you digitally. It is basically a trend that is supported by demographics and accelerated by client behavioral change. So whether it's in the consumer services or in the financial services or whatsoever, I do think that the technology business models, the ones that are digital, still are the right ones going forward, because they are real business models. So the question is, what is the exact value to put on them right now? But it's not like we had like 20 years ago in the .com that basically we had some models that were just models on paper and not real. The last 20 years, we have actually been able to show that there's real changes happening in the retail business, in the financial business, etc. So, and that trend is not going to stop because of what we see currently.
We can come back to that, but I'm very interested in you talking about the three factors: the war, the pandemic, and the energy transition. I would like to expand that, and I think you have a great degree of sympathy for what I'm about to say, because from many conversations we've had with you, you've talked about interest rates and about the need to perhaps have more normalised interest rates, and perhaps some of the negative rates we've seen have just been quite blatantly wrong and bad for banking and bad for the allocation of capital. So I would say to you, the means to normalise interest rates, plus the end of the bond market bull run, plus the fact that you've got valuations which, quite frankly, by many metrics, and CAPE is one of the best I can think of, look wrong, and the fact that we have ridiculously high debt loads compared with historic levels, I would say those other expanded factors are actually the real reason why we're seeing this chaos now.
Yeah, it's a combination of what do you think is going on and what is a real problem, like a supply chain problem, commodity prices, etc., 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 cost of labor. There's just, if you see that there's quite some tension in the labor market in terms of qualified labor, those are real issues, right? So, and if we are going to bring the supply chains closer to home, then everything that we have been managing over the last 20 years in keeping the inflation down by moving the supply chains further east, if I may say it like that. But if you then roll them back up, inflation is going to be there, right? So, and that will give tension to prices, labor, etc., which is exactly what we're seeing. So that is to be expected, and we can manage that. In order to manage that, honestly, I do think that, coming back to the rates then, I think you can move rates back into positive territories, certainly at this moment, because it's very unclear as to what is happening at this moment anyway, right? So I don't think that moving rates back into positive territory itself is restrictive. High rates will be restrictive.